Hello everyone. In previous classes, we are done with the types of the derivatives, forward contracts, future contracts and the option contracts. Let's have a glimpse of this. Forward contract is a contract between two parties to buy something in a future date where the price is fixed, okay, and the price of the contract is on the basis of the underlying asset. Future contracts are as like a forward contracts where the intermediary, a standardized organization, is there to control these transactions. Option contract is a contract where one party has the right to execute the contract. One party has the decision making power and another party doesn't has the decision making power. If one party decided to execute the contract, yes, another party should agree. If the party is decided to cancel that particular agreement, then another party has to agree. So when the buyer has the right and seller has the obligation, it is called as the call option. When the seller has the right and the buyer has the obligation, it is called as the put option. And the amount to be paid by the holder of the contract. Holder of the contract means a person who is having the right. So amount to be paid by the holder of the contract to the writer of the contract who is having the obligation is called as the premium. So these all things we have already understood. So the last type of the derivative, it is called as the swaps. So let's see what is swaps. A swap is an agreement between two parties to exchange the sequence of the cash flows over a period in the future. So sequence of the cash flows. So let's say I have one debt instruments where my cash flow is fixed and another party is having the floating return. Okay. Now I am ready to take the risk and I need the floating returns and my opposite party needs the fixed return. What we both can do, we can enter into agreement and we can exchange our cash flows. So this is called as swaps. So here the exchange of the cash flow is there. Exchange of the return what we are going to get is there, right? So this is what called as swaps. A swap is an agreement between a counterparties to exchange the future obligation, okay, of the cash flows over a period of time. So party A, party B, both will be there. So one set of the cash flows and another set of the cash flows. So these two set of the cash flows are exchanged. This is called as a swap. So swap is nothing but the exchange, and exchange of a different type of the cash flows are here. Here is a few types of the swaps. One, interest rate swaps, currency rate swaps, equity swaps, credit swaps and commodity swaps. So interest rate swaps is nothing but the different type of the interest rates. Currency swaps is nothing but the different types of the currencies. Okay, so different types of the currencies are swapped. Equity swap is nothing but the returns from the equity is swapped. Credit swap is the returns from the credit is swapped, and commodity swaps where the two commodities are exchanged. Let's understand the uses of the derivatives. Derivatives are useful to the corporations, business firms and multinational companies. It is also useful for the mutual funds and investment companies. It is useful for the individuals, financial service providers like banks and other financial companies, market operators like traders, hedges, speculators and the arbitrages. Okay. So let's understand who use the derivatives for what reason. All these parties, okay, either corporates, business firms and multinational companies, or the mutual funds, investment companies, individuals, financial services, banks and other financial companies, market operators, traders, hedges, speculators, arbitrages and all are using the derivatives to manage the risk. Okay, so obviously the derivatives are the risk hedging strategies, correct? So to manage the risk or to decrease the risk because of the market fluctuation, they are going to use the derivatives. Generating higher income. So because of the derivatives, they can generate the higher income, correct? If their expectation is become true. So before entering into the derivative contracts, there will be expectations of both the parties, and if the expectation is became true, then obviously it will be a beneficial for them. In the previous example, if the price of the banana is increased to 45 rupees, then as per the contract the price is 35 rupees. I can execute the contract, right? I can get it for 35 rupees, whereas I have saved 10 rupees per kg. Am I right? So suppose if I don't want it right now, okay, suppose if I don't want it right now, I can sell it for 45 rupees in the market and I can earn more profit. Trading efficiency. So for the efficiency in the trading, so what is the efficiency in the trading? Let's say you are promised to someone to deliver some of the products, correct? So to achieve that one, you are going to enter into the derivative contracts and financial engineering. So there is something called portfolio. It is the combination of the investment of different types of the securities in a different market and in different industries where you will get the maximum profit. And suppose some of your expectation is gone wrong, then obviously you can alter those portfolios, correct? So you can use some of the alternative portfolios. For that the financial engineering is needed, and through derivatives you can achieve this one. Here is some of the activities which are involved in the derivatives, that is hedging to reduce the risk, speculating, buying at a low and selling at a high in future, arbitraging, seeking the risk less profits. There are few participants in the derivative markets. They are called as hedgers, speculators and arbitrators. Hedgers are risk eliminators. Hedgers eliminate or reduce the price risk. Speculators assume to take the price risk, hoping to gain risky profits. Arbitrageurs snatch to generate riskless profits by taking the advantage of the price difference between two markets. Okay, so this is in brief regarding all these three types. Okay, let's understand the hedgers. They use the future and option derivatives to reduce or estimate the risk associated with the price of an asset in the market. Here, hedgers means they are trying to eliminate or diversify the risk. So to reduce the risk of the future fluctuation, they are going to enter into the derivative contracts. Okay, so they are called as hedgers. So here the strategy of the hedger: forward contracts, they are trying to eliminate the price risk, and through option contract they are trying to minimize the price risk. Speculators are risk seeking traders or investors. They are willing to assume the risk by taking the future positions with expectations to earn profit. So at the beginning they will buy at the lower price, and by expecting in future the prices will increase. Okay, and they are going to sell it for the higher price. Fine. So this is what called as the speculation. And as like in the stock market, there are a few speculators like bull, bear, lame duck, right? So the same speculators are also here. So this is what the speculation transactions. Arbitrage, there is a spelling mistake. Arbitrage is a simultaneous purchase and sale of the same underlying in two different markets. For example, let's say Reliance Industries stock. In NSE, the price of the Reliance Industry may be 1815 rupees. At the same time, the price of the Reliance Industries stock in BSE may be around 1900. At the same time, same stock, same quality, same quantity, price may be different in a different markets, right? So they are going to take the advantage of that, and they are going to purchase in the market where the prices are less, and they are going to sell it in the market where the prices are more. So this is what called as arbitrage transactions, and person who is doing this is called as arbitrager, and they all are the participant in the derivative markets. Okay, that's it for today's class. In coming class we are going to speak about the functions of the derivative markets.